Folks. It's Dave Burrows. I am CEO and CIO, Chief Investment Officer here at Barometer Capital Management. And I want to thank everybody for jumping on today. Lots to talk about. We've all been thinking about markets over the last couple of weeks. Companies have been reporting their earnings. So we've got a lot of information and things to think about going forward. Coming out of earnings period, corporations get back to buying their shares. But certainly it's been a little more volatile over the last few days and some things under the surface that I think we need to talk about because I think they're relevant. Let's just start from the top. Market has been working its way through this structural bull market now since 2013. And to be clear, there's times to be more invested, and there's times to be less invested. We see our job is to identify and focus portfolios in areas of market leadership. That could be sectors or themes or geographic regions or asset classes that are seeing net new inflows of capital. The way we make money is we own things and people come in behind us. And if we've done it properly, they're willing to pay higher prices than we paid. Over time, our job is to recognize change, new leadership as it emerges, and old leadership as it recedes. In the absence of leadership, have an ability to play defense. So you get a day like today, and people ask the question, should we be playing some defense? We talked a little bit over the last couple of weeks as to some of the trends in breadth that, we're thinking about, and they're causing us to be a little bit more cautious. So let's talk about that. Here's the S&P going back to 2013 for the month of November. Now we're down 0.6% in the S&P, so that's a pinch of nothing after going out at highs in October. When we put it under a microscope and we look at the sell-off in the spring, which was driven by the tariffs, S&P sold up 21% and very quickly regained what it gave up and really has stayed in this channel above the moving averages ever since. Having said that, it's gotten a little more wobbly over the last month or so. We broke down out of the channel briefly and back up into it. A couple of gappy up days where we left these gaps behind. And in the last 4 or 5 days, markets come off a little bit and broken back down below that channel. So it's above a rising 200-day moving average, 50-day moving average, 21-day moving average, but now below the 9-day moving average is something to think about. When we look at the Nasdaq 100, this is an important index because, of course, tech has been leadership for a long time. Coming off the lows in April, you can draw a trend line that moves up and through these lows, and you can see this narrowing wedge that we broke out of early in October, and then managed our way up and go. But again, this during the earnings period, a couple of very gappy days where we jumped from a high close to a higher open to another higher open, leaving behind these gaps. Now, one of the things we know from a technical perspective is for whatever reason, when the market leaves these gaps behind, very often we go back and fill them. So as we moved higher in this channel, you can see that today we broke back down out of the channel. So we're busy filling this gap. We'll see whether we fill the gap below it. But this is a pattern that people have been watching as this band has become narrower, that there is risk that we break down out of this channel and stay lower. So something that we definitely have to watch. When we look at the Russell 2000, it's obviously underperformed. We put in a high in 2022. We tested the high in 2024 and only recently traded above it, but quite quickly to come back down below that trend line. So while it's encouraging that it did break out, one of the things we always care about is when trend changes, does it stay changed or does it fail? So we'll see. Now look, there's a lot of ways to make investment decisions. You can follow charts. And when you're following charts, you're following many times indices. And indices are made up of a lot of companies in that index, and very often they're market cap weighted. So the largest holdings in the index color the view of the index as a whole. So one of the reasons that we care so much about breadth is because it gives us context. Now, we've said over and over again, 70% of return in a portfolio comes from getting to the right asset class and getting to the right sectors within that asset class. In other words, being in the right neighborhood. So a big part of what we do is we take all of the various investable universes we could focus in, and we run models that track breadth, the percent of securities within that universe that are performing well. And ideally, we want to see expanding breadth. We want to find sectors and themes that are seeing new net dollars get put to work. And we're going to focus our attention in those areas. I put this up all the time, but when you go through a long decline, generally by the time you're late in a decline, everything's been hurt. When the most aggressive folks put money to work, the strongest securities often turn up first. That's people being willing to step into a weak market to buy something they have a lot of confidence in. In a healthy market, as the market bottoms and then rallies, over time, more and more stocks should participate as more and more money gets brought to bear buying securities in that neighborhood. So there's no bear markets take place when breadth is expanding, and that's why we care. Very often, late in advance, while the leading stocks continue on, the weaklings start to give up some of the strength. So we care about that. When breadth starts to deteriorate, that tells us that maybe the ice is getting thinner under our feet. Now, of course, just because breadth is narrowing doesn't mean we should go out and sell the leading stocks. You can get correction over short periods of time. It resolves and breadth starts to expand again. But when breadth starts to contract, we care. It means we stop putting new money to work. It means that we get extra vigilant and critical of our existing positions to say, do they continue to meet our tests? And generally, we'll tighten up our stop losses. So we'll raise a little cash, tighten up the stop losses that we've got under existing positions. And to the extent that new money comes in, or we've taken positions off and have cash, you don't put any new money to work until breadth starts to improve. Now, last week, I talked about the fact that some of the short-term indicators and some of the long-term indicators, in particular in the US stock market, had been flagging. Last Tuesday, on a day where the market was up, there were 400 companies down, 100 companies up. Now, it happened to be that NVIDIA and a couple of other large companies had very good days. But that was about the worst day for advancers versus decliners going back to 1990. That day, as the S&P cap weighted or market cap weighted index marched higher through the day, the equally weighted index was weakening. Now that happened 3 days last week, and it happened again today. When we look at breadth as a measure of market health, the percent of stocks in the NYSE that are in long-term, clearly defined upward price trends has been narrowing. Now, last week I put up the chart. In June of this past year, 76% of stocks were in uptrends. Today, coming in, it was 45%. And my guess is it will have moved down 2 or 3% more today. So what does that mean? It means the weakest stocks got hit in the beginning. As selling goes on, it hits stronger and stronger companies, which is why we try not to put any new positions on while breadth is weakening, because maybe you happen to put on the one that's going to get hit next. Now, under the surface, the short-term indicators, percent of stocks trading above the 50-day moving average, now down to about 30%. The percent of stocks with upward trajectory or positive weekly momentum has been narrowing as well. Percent of stocks making new highs versus new lows, weakening, and percent of stocks trading above the 150-day or long-term moving average, now below 50%. So what does that mean? It means we don't put on new positions. It means we've probably taken off some positions. Now, it's not the same everywhere in the world. Globally, breadth has continued to be very strong. In Canada, we saw a little weakness this week in large caps. So something to keep in mind as well. Now, seasonally, we put this chart up before. The second half of October, November, and December tend to be three pretty good months. Why is that? Well, we're coming into year end. Very often managers are lagging the benchmark. Very often they've had some cash in their portfolios because you do have weakness in September and the beginning of October, and they start to chase. Also, as you come out of the earnings period, corporations come out of their blackout period, and they can start additionally buying more shares to buy back for their treasury, corporate buybacks. So if we look forward, the week of November the 10th, really we get back in earnest to corporate buybacks. And we would expect somewhere between 10 and $15 billion worth of buybacks in that week. For the final 6 weeks of the year beyond that week, it looks like more like 25 to $40 billion a week. So that's nice support for the market. And then it depends what individuals do, what pension funds do. But as you come into the end of the year, it tends to be people are buyers. Now you can see that portfolio managers have right now a short position in S&P 500 contracts. And that ranks in the bottom 2% for positioning in the last year and the bottom 10% for the last 5 years. What does that mean? It means that they could choose to cover those shorts, and that would be additional buying. So there are things out there that could take place to cause more money to come into the market. But I do know that breadth has been weakening, and we always care when that happens. We always get a little bit more cautious. We look at positioning. Private client investors at Bank of America are about 66% equities. And you can see going back over time, that's pretty significant long position. When it comes to cash, they have just about the lowest cash weight that they've had going back over the last 20 years. So that means you shouldn't expect a lot of new net buying to come from private clients. Let's look outside the US. Developed market, ex-US, has been marching higher month by month, and it's down a snip for the beginning of the month of November. If we look at the Eurozone, it's been steadily marching higher, down a very snip for the beginning of the month of November. But if you look at the Euro Stoxx 50 versus the equally weighted S&P, after underperforming for many years, it is now outperforming. The Japanese stock market, which has had a great year, up about 28% from the point where it broke out to new highs, has had a very small pullback at the beginning of November. Nothing to write home about. Korea, same thing, broke out. It's pulled back a small snip at the beginning of November. And Shanghai is up so far in the month of November after moving up 1, 2, 3, 4, 5, 6, 7 months in a row. So if you took the top 50 companies in Asia, the relative performance versus the S&P has been rising steadily. In fact, today was at a relative strength new high. Peru has been very strong, a little weaker at the very beginning of the month. And Latin America. Latin America is at a new relative strength high and 1 day off absolute highs. And then we talked about emerging markets over the last little while. Same thing, improving relative price performance versus the US, down over the last 4 days. But again, nothing broken whatsoever technically. So this is going to be an interesting way forward because when we look at the emerging markets ETF, EEM, we're within a whisper of taking out highs going back to 2007. So the relative relationship, all world ex-US equities versus equal weight S&P. In the month of November, we're at another new high. So we said over the last while, we're in the very early stages of a period where likely international equities outperform US equities. It's a cohort of stocks that are underowned in general by pension funds and individuals. And it's a cohort that's relatively inexpensive relative to US stocks. The TSX down marginally on the month, but again, from a relative price performance, continues to make higher highs. So if we take a look just quickly at how things are going internationally, the equally weighted S&P over the last 2 years is up 30%. The all world ex-US index is up 44.8. Our Barometer International Fund, the Barometer Global Fund, up 57.9. It's about 13% ahead of its index, fully costed, and it's doing better than we had hoped. We were hoping for 5 to 6% outperformance per year. We're running ahead of that. Now, things that could have an impact. One of the things we're watching is the Supreme Court case that's going to hear oral arguments against the International Emergency Economic Powers Act that Trump used to put tariffs on countries around the world. Wednesday morning, we start to hear arguments. So what are we likely to learn? We aren't going to get a ruling until late November or early December at the earliest. But we are going to start to see some color. So one of the things we're going to want to watch is what the judges ask by way of questions. 3 of the appointed Supreme Court justices were appointed by Democrats. We would expect they're likely voting against the tariffs. 6 justices have been appointed by Republican presidents. And so the question will be, will there be any harsh questions at all towards the Trump team on these tariffs from any of the Republican judges? If not, it may well be this is nothing. If things get a little bit more heated and a little bit more difficult, the market may take that there is a possible unwind in the tariffs, which would mean the tariffs have to get paid back. So for us, that's about as much information as we're going to get this week, and then we'll watch as we go forward. So going forward, international markets have started to perform better. And when they started to perform better in the late 1990s and early 2000s, 4 things happened. Ex-US equities started to outperform US equities. Commodities started to outperform equities. Value started to outperform growth. And small companies started to outperform large. And going forward, this continued until 2008. Now, we know over the last number of years that all of these things were the reverse. US stocks outperformed. Commodities did not perform until 4 years ago. Value has underperformed growth, and small companies have underperformed large. So it's going to be important to see these changes and what happens going forward. But in this case, we are seeing a change in relative performance of international stocks. We're seeing a difference in relative performance in commodities. We'll see whether we get the other 2. Moving on to fixed income. This has really been about the same going back to 2020. Long-term interest rates have been making higher highs and higher lows. Now, we recently pulled back to 4.6% on a 30-year US Treasury. Actually got down to about 4.5% at this support level and has moved higher off it. But one thing that we can say is while bonds have been relatively unproductive, concerns around the volatility of interest rates have been waning. So one of the things the stock market hates is interest rates that are moving very quickly. And as interest rates have become less volatile and bond prices become less volatile, less concern for the stock market. So that's a check mark in favor of stocks. If we put all of the choices that we have in our income strategy into a bucket, the best performing set of securities has been dividend growers. And so we like to keep putting this up on the screen. Clearly, since rates bottomed in 2020, dividend growth has been the strongest cohort. And again, in the month of November, it continues to be. So dividend growth continues to be our focus. And when we look at the key holdings in the income strategy, the average security has given us 18% dividend growth over the course of the year. So yield with some dividend growth is a great way to offset a rising cost of living. And we think that that continues to perform well. This is the core of almost all of our portfolios. Okay, moving on to commodities. Again, commodities have been generally marching their way higher. Again, this month, a little bit higher than where we were in October, a little bit higher than where we were in September, a little bit higher than where we were in August. So clearly the market is saying that inflation continues to be an issue. Gold has pulled back a little bit off the highs. We talked about this over the last 3 weeks. We said gold had become extended above the long-term moving average, 85% above the 200-week moving average. And in the bull market that happened in the 2000s, you got extended just about 80% above the 200-week moving average before you got the first correction. You had a three-step correction, down, up, down, and then we moved along the higher moving average. In the last 4 weeks, we have seen a pretty significant outflow from gold. And I think most people know we stepped aside from our gold equities over the last 2 weeks and our gold holdings, and we'll see where we go. So far, from 88% above the long-term moving average, we've had 1, 2, 3 weeks down. And we think that that probably could continue down toward this rising blue line, which is a 50-week moving average. That will be down at 3,200. So corrections come two ways. They come in time or in price. In the very short run, things probably got a little overcooked and maybe need to correct. But to be clear, this move that we've seen so far is minute compared to the bull market of the 2000s and the bull market of the 70s and 80s. And there were several steps along the way, so likely we'll be re-entering those positions once the correction runs its course. The one thing that is clear is central banks continue to be buyers of gold, and that's ultimately should be supportive. So we put this chart up over the last little while. Gold relative to the QQQ, or gold relative to tech, turned up from a relative performance standpoint in 2000 and 2001 and outperformed until 2011, and then underperformed from 2011 to 2022. And since then, gold's been outperforming. Nothing here changes that. Outside of gold, platinum pulled back a little bit in the month of November. Copper's pulled back a little bit in the month of November, both very, very early stage bull markets. But when we look at relative performance, commodities continues to outperform bonds, and commodities continue to outperform the equally weighted S&P. So it's an asset class we have to pay attention to. The market's telling us that inflation is going to continue to be a problem. Okay, what other moving parts do we have to consider? Currency. We talked a lot about the US dollar after a long period of strength, going through a topping period and breaking down over the last year. When we go down through support, it's very possible we go back and retest from the underside, which is what we're doing right now. So this is going to be important to see if the US dollar versus the pound versus euros versus yen can reverse and get going. My guess is we probably test from the underside and then head lower. One of the things that causes us more concern about growth stocks is how Bitcoin is acting. Now, very few of our clients own Bitcoin. We had some Bitcoin in our macro portfolio. We made some money on it. But this is the price of Bitcoin going back in this period here since July. And we consolidated within this box. But as of a couple of days ago, started to break below the 200-day moving average. So for the people who know us, who know we do stop losses, you can expect to know that we sold our position. I only mention it because a lot of the holders of Bitcoin are the same holders of technology shares. And to see Bitcoin breaking down like this tells me that that might have an added dimension of risk for equity holders of the technology companies. So just something to keep in mind. Okay, let's talk leadership. We've had pretty stable leadership over the last few years. Financials have been strength. So they came out of a period of 2007 through 21 where they didn't make a new high. We had a first leg higher, a global central bank tightening cycle, and financials have been marching higher since. So the very first position we put on back in 2021 was JP Morgan. We bought JP Morgan because while the financials ETF didn't make a new high till 21, JP Morgan made a new high in 2013. It was the leader. The strongest balance sheet, best management, the best technology platform, the go-to bank for strength. So does it continue? JP Morgan relative to the US large banks This is JP Morgan relative to ETF KBE. And you can see pretty clearly it continues to outperform. This would be a top 10 position for us. Also in our top 10, Morgan Stanley. This includes right up to the close today. Morgan Stanley did trade at a new high today, closed basically right on the 8-day moving average. Relative strength continues to move higher. No change here. Last week, we talked about the fact that insurance has been weaker in general. The card companies have been weaker, but the large banks have continued to perform. And Morgan Stanley and JP Morgan are doing their job. In Canada, of 1,500 ETFs today in North America, one ETF made a relative new high versus the S&P, and that was the ZEB. That's an ETF that owns an equally weighted basket of the 6 biggest banks in Canada. So not only did it make a new all-time high yesterday, but made a relative strength high today, down 50 basis points on a day when the Nasdaq was down 2%. I would say that's leadership activity. And staying with Canadian financials for a moment, one of the positions in our income portfolio, Power Corporation, which owns IGM Financial, which owns Lifeco's, which owns some renewable energy, new relative strength, new high today, new absolute price high up on the day against a very weak market. So financials continue to behave well in North America, and in Europe, Eurozone financials continue to perform well. Relative price performance versus the European index have been strong, and our largest position, Santander, relative to European banks, made a new relative strength high today. So largest weighting across the firm would be financials. I think they're handling this little sloppiness over the last week really effectively. We're feeling pretty good. Industrials. This has been the other major area of strength. Industrials, the equally weighted index, continues to march its way higher above all long-term moving averages. The defense sector continues to lead both in the US and in Europe. That's the US Defense and Aerospace Sector ETF ITA. Howmet Aerospace. Boy, what a holding this has been. Made a new relative strength high today, just slightly off the absolute highs. And GE Aerospace, same thing, relative strength continues to march its way higher. Now, the other area that we've been focused on for industrials has been power generation. The companies providing equipment into the utilities and into the grid and into data centers so that they can be self-sufficient, continue to do well. I mean, the power needs are just going to continue to grow. And so the companies providing it should continue to perform well. And Caterpillar, after a massive week last week, has consolidated over the last 3 or 4 days, but trading better than 91% of companies in the S&P. Having said that, we did come out of GE Vernova, which broke support today. It's been consolidating over the last 3 months. And given the market weakness and given the breakdown, we just thought it was time to step to the sidelines. We'll watch this one for an opportunity to re-enter if the technical picture gets better and if the breadth gets better. Finning continued to perform well this week, made a new absolute high on Friday after reporting very strong earnings. And moving on to the materials, the gold miners are the same story as the gold itself. We did step aside given the fact that we got extended, and you can see that it's had one move down the 50-day moving average, an attempt to rally back above the 50-day, and it failed today. So my guess is it's headed down toward the 200-day moving average. So for those that are long, we aren't at this point. Just know that that's a possibility. We think that there's going to be a great opportunity to re-enter these things, but we're going to have to let some traffic pass first. Okay, also in materials, copper down a little bit in the month of November. We think it's very early days for the copper producers, so we're not too concerned. You can see that in the short-term chart, the COPX ETF did have some gaps higher over the last 3 weeks. And maybe we go back and just fill this gap. You can see we filled the gap today, just above the 50-day moving average. So at this point, technically, I think things still look pretty good. And the uranium producers have pulled back a little bit so far in the month of November, but again, no technical damage here. chemical continues to look very, very strong. So the commodities continue to be pretty good. Frankly, energy, this is energy producers in Canada, the XEG ETF, just marched sideways as the market is consolidated. And given the weakness in the price of oil, I think that they've been remarkably good. Suncor looking really strong. Imperial's maintained its strength. CNQ's maintained its strength. Tamarack Valley's continue to be strong. And I think really we're just getting a waiting game here. Okay, so let's talk tech just for a minute. This is the XLK. It's a market cap weighted ETF of the largest tech stocks. NVIDIA, 15% of the index. Microsoft's 12, Apple's 12, Broadcom's 5, Palantir's 4. So what a great recovery after a 25% decline through March into April. But I am watching this price pattern, this narrowing wedge where we traded right up to the top of the wedge and have broken down out of it. So I think it's too early to know. I think most people know we've been underweight technology. We're about 10% versus 30% in the S&P. But we do have some very strong holdings. NVIDIA one, Google another, Microsoft a third. And those three all still technically are fine, although we did trim some weighting in Microsoft and Google, just given some of the risks we see in the very short run. You can see semiconductors, same picture, strong relative strength, but a down day today. We'll see whether we're just filling these gaps or whether it can revert and head higher when NVIDIA reports its earnings. So not a lot changing. I mean, the market is probably a little more challenged in the short run, but the leadership groups continue to behave pretty darn well. And very few stocks in those groups breaking down. So the next question is there something else we should be looking at as an alternative? Or the groups that have been underperforming, are they seeing new relative price strength? And so far, the answer is no. The groups that you'd expect to start performing well if the market was going to really get hurt are still showing no relative performance. Consumer staples. This is the XLP ETF. What a horrible looking chart. Trading below all of these falling moving averages of relative strength made a new low as of yesterday. Consumer discretionary. 70% of the US economy. This is an ETF that's almost equally weighted, a basket of 50 consumer discretionary stocks. You can see that relative price performance has been weak. Now we're below the 50-day moving average, challenging the 200-day moving average. And obviously not a lot to do here. Home builders, the housing market. Nothing to do here. Weak relative strength, weak prices now below the 200-day moving average, which is falling. So these are things that make us cautious on the consumer. And REITs, things that are hurt by higher interest rates, relative weakness. So let's just look at the progression of breadth for the various groups that we follow in the US stock market. On the 6th of October, the average sector had 51% of stocks in uptrends. You can see most sectors were in capital letters, which means breadth had been expanding. The strongest groups at the far right side here, banks, semiconductors, precious metals, regional banks, aerospace, the groups we've been talking about, metals. If we fast forwarded to the 20th of October, 47% of stocks in the average sector were in uptrend, so down about 4%. Still, most of them in capital letters. If we look at sector breadth today, this is before today, 45% breadth narrowing, but you can see a lot of sectors in small letters, which means breadth is contracting. So when we have breadth contracting at the market level, obviously we're going to have some breadth contraction at the sector level. And we care because the market is a sorting hat, what's happening. And you can see some important groups have had some rent damage. And that just tells us sit on our hands. So what does it all mean? Well, financials continue to be our biggest weight, roughly 20% of firm assets, and continue to perform well. Industrials relative to a month ago are actually up from a weightings perspective. They continue to act well. Look at cash. Cash now, the third largest weighting. This is coming into today, probably a little higher after today, probably a little north of 15% for the average account. That's flexibility. That gives us opportunity. If this correction were to go a little further, we're going to have opportunity to put money to work later on once spread starts to improve. If the market continues to correct, we will wind up with more cash. Tech, the highest valued sector in the market, about 12% of assets. That's about a third of the market weight, and probably a little lower as of today because I think we probably raised about 3% cash by trimming positions closer to 10. Materials, after taking our gold position off, down at 8% from 15, but still a significant overweight, and commodities are outperforming equities as a whole. Energy is about an 8% weight, about 3 times the market weight in the US, but a significant underweight to the Canadian market. Frankly, being very resilient. We'll see if we start to see some improvement in Brent. We'll see if we get an opportunity to add there. In the defensive sectors, really nothing to do. Real estate investment trusts continue to be weak, staples continue to be weak, consumer discretionary weak, and healthcare continues to be weak. Utilities, we added a small position in Capital Power over the last month, which is a growth utility selling power into the data centers. Maybe we'll talk about that next week. So the portfolio is set up to be pretty resilient and pretty cautious. We're going to follow our stops, but I think it's really relevant that early in the 2000s, the strongest performing assets by year were emerging markets, developed market, international, REITs, and commodities. Now, REITs were doing well at that point. But again, in the top 5 weightings for the year in 2004, commodities, emerging markets, developed markets. 2005, emerging markets, commodities, gold, developed markets. 2006, emerging markets, developed markets, gold. 2007, emerging markets, commodities, gold, international. So here we are in 2025. Golds have been the best performing asset, emerging markets second, developed markets, international third, and then the S&P. So I think that this can continue. We'll see whether the S&P can get back on its feet. We have a lower than typical weight in US stocks, as we've talked about. And for our strategies, I think things are going pretty well. In Canadian dollars, the equally weighted S&P is up 5.8% for the year. Currencies had an impact. The aggregate bond index is up 4.2% on the year. Our equity portfolio is up 19.6%. Our income portfolio, which is dividend growth focused, is up just under 11% versus the bond index up 4%. Our global portfolio up 24.09%, and our macro portfolio up 21.58%. I think things are going well. I think that we're not out on any limbs. I think we've got lots of flexibility, and we're going to continue to watch our risk metrics. The credit spreads have widened a very little bit for high yield bonds, but that tells us that credit investors are still pretty comfortable, and the spreads on investment grade bonds continue to be at tights. And when we look at volatility, which often spikes if you're going to get a real problem, volatility as of the close today was at 18, which is right in the middle of the box that we tend to be in cyclical bull markets. So maybe the market's correcting. Maybe it'll be more than that. Maybe it is that seasonality will kick in the next couple of weeks, and some of that money from corporate buybacks will have an impact on the market. We're going to have to take this step by step. Investing is a game of factoring. It's a game of iterations, and it's a game of discipline. We're going to follow our steps step by step. At the end of the day, we continue to be in a structural bull market. If things get more difficult, we can always raise a bit more cash and get a little bit more defensive, as we tend to do across a weaker market. So with that, let's see what questions we've got today. Okay, Anonymous, what's your present take on GE Vernova, and do you still own it? So as I mentioned on the way through, we did take the position off today. It's been a great holding for us. We've done very, very well with it. Given the relative weakness over the last few weeks and the technical break today, we thought it was time to step to the sidelines. We think it's a great business. We think they've got a great order backlog, and long term should be very good. But we need to see fundamental characteristics in the income statement, the balance sheet, that point to something changing for the better. And as always, we need to see price doing what we would expect it to do, given what we think we know. And the near term, the technical picture is a little bit more challenged. So we've gone to the sidelines there. Lawrence Knight, when you say you've moved out of gold, does that mean all positions or partial trim? It means basically all positions. The thing you have to keep in mind is that commodity producers can be volatile. And while gold has been less volatile than a treasury bond over the last 3 years, it is showing signs that it is going to correct. And the stocks will correct more than the metal. So it would not be unusual in the first correction in a bull market to see gold producers pull back 35 to 50% from their highs. So I believe we're in a long-term bull market and it's going to go on a decade. But having said that, we're not in the business of sitting through 40% pullbacks. So we stepped aside and we took some really good gains. If the economy does drift into a no or slow growth environment with higher inflation, which sectors would we expect to do better? So from Paul, I think historically, commodities tend to be a good hedge, in gold in particular. Financials tend to be a pretty good hedge. Industrials, if the economy really slows, will get hurt. We aren't getting a sign of that right now. And certainly, we don't want to own consumer discretionary. So the way that we have hedged ourselves currently is that, we have been in gold, but we've stepped aside. We don't have any consumer discretionary exposure to speak of. And our financials continue to perform well. So we think we're in a pretty good spot. The key thing I think that we want to own is companies that generate free cash flow and don't need debt financing. Because if the market assesses that there's higher credit risk, the cost of that financing can go up. So when we look at the holdings that we have across the firm, we have very few holdings that have any debt. Most of them are companies that have shown a willingness and an ability to raise their dividend almost every year because they generate so much cash. And those are the types of companies that should do well if the economy were to flag. Let's see. What do you think of Hammond Power as a player in the energy grid? I have to be honest, we haven't taken a look at it recently, so I probably should do that. Where we stopped out of MDA space over the last few days, we have exited MDA space. Not a question, just a comment. Audio's been going in and out for a lot of this session. Oh, that's too bad. Perhaps invest in one of those professional podcast tape microphones. I have one, but it's not working properly today, and that's probably why. So I apologize for that. I think that's it. All right, guys. Thanks very much for joining this week. Tough day today for people. I think that we're in a pretty good spot. Just make sure if you are managing your own positions that you've got discipline around yourself. I think one of the most important things when you get into a correction is making sure that a little mistake doesn't turn into a big one. And it's hard to step aside when we're vested and have done the work to want to own good companies. But you have to be able to change your mind and step aside from time to time. It's always important to fight another day. Hope everyone's having a good week otherwise. And sad about the Blue Jays, but we were really proud of those guys, and next year's another year. Okay, everyone have a great week.